Hey guys, welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And I'm excited that you've joined me today. We do this show live every Tuesday to help you learn the ins and outs of passive real estate. So today we're going to talk about mortgage rates. We're going to explain how they're actually calculated. I think there's a lot of misconceptions on who actually sets mortgage rates. And we're going to dive in on what exactly you need to know as a passive investor to be able to eye mortgage rates. One, to figure out how to take advantage of it for investing in today's market. But two, when is the best time to jump back into equities? Okay. Anyways, if this is the first time you're joining, you're in the right place if you want to learn how to turn your active income and savings into passive income and long-term wealth. So maybe you've tried investing in passive real estate before, but couldn't quite get comfortable making the investment, or you actually invested in a deal before and you're like, oops, I needed to know a few more things in order to actually, be a good, solid investor. Or you just are, well on your way, you've scaled a portfolio, and now you're just looking to level up your skills. If that's you, you're in the right place. And if this is the first time you and I are meeting, a little bit about me. I actually started real estate investing back in 2002. Started out living, flipping, and house hacking, then got into flipping, and then got into buy and hold rental real estate. And over the course of like 22, 23 years, scaled over 800 million in active assets, as well as my passive portfolio. But really, that has all served to do one thing, which is to help me spend more time with my crazy crew, pictured here. We love traveling and spending time in the great outdoors. And what I get to do, how I want to spend my time, is with you, educating you. And I've documented a lot of my investing journey in my book, Money for Tomorrow: How to Build and Protect Generational Wealth, published with Bigger Pockets. But again, all of this is to say, all of those metrics that you saw on that previous slide, the 6,500 residential units, all of the cash flowing businesses, that has allowed me to do one thing, which is to get 100% control and choice on how I spend my time. And we can help you do that here at passiveinvesting.com. We have 1.5 billion assets under management. And more importantly, I think even right now in today's market, we're deploying a lot of capital into fix and flip real estate. And the debt side of things, we are being the bank. And so as we go through today's presentation, I want you to kind of hear what we are doing, where we see the opportunities in the market, and how we are leveraging where the market is today. And so you should check out our Pick Real Estate Debt Fund if you want some base cash flow, and then we have some other debt fund opportunities as well. And you can find those at passiveinvestingwithwhitney.com. There, if you fill out a little form, you're going to get priority access to our open deals, an opportunity to jump on a one-on-one call with me, and then, of course, access to all of our educational resources. Now that brings me to the disclaimer. We always have to have a disclaimer. Everything that we go over today is for educational purposes only. So please do not construe this as financial advice, legal advice, tax advice. So if you see anything that is going to impact your investing strategy, make sure you sit down, absorb that information, consult with your legal and tax team and your financial team before making any moves. Now, over the past several weeks, we've been talking about how can an investor in 2025 take a very strategic approach to how the markets are changing. And it's not that we are having this huge pivot, it's just that we're seeing a lot of volatility. Okay, so multifamily real estate, even self-storage real estate, hotel, hospitality type real estate has gone through different parts of the recessive cycle over the past few years. But on a national level, we're starting to see more of those, global market or national market indicators that the U.S. is heading indeed into a recession. We've tried to stave it off as long as possible. Now, a lot of investors think if we go into a recession, the Federal Reserve has to drop interest rates, okay? Because we're in a recession, the economy's hurting. So of course they have to lower interest rates. Okay. But let's talk about who actually impacts mortgage rates, especially on the commercial side of things. Okay, so the Fed isn't the only player. Okay, the Fed's fund rate, that is the short-term rate banks charge, each other overnight. Then you have the LIBOR, the London Interbank Offered Rate, that's kind of been phased out since 2023. More of what you see in play, especially in the commercial space, are mortgage rates that are based on SOFR, or the Secured Overnight Financing Rate. Okay, again, in about 2023, it fully replaced LIBOR in the commercial markets, and it's based on actual secured transactions in US Treasury market. Now, that's a very important note that's going to come into play here in the next couple slides. But, when we're talking about commercial mortgage rates, maybe you've been an active investor yourself, or you're a passive investor and you've taken a look at the different debt structurings on some of the operators' deals. They're usually going to be based on a LIBOR, a SOFR, or the Fed funds rate. Okay, so one would think if the Federal Reserve moved rates, that the commercial mortgage rates would come down, right? Okay, but there's not a direct correlation here. Now, before we move on, I just would be remiss if I didn't mention that when we do look at commercial mortgages, we can fall in a couple of different camps. We can do a fixed rate for a period of time, say 10 years, maybe even 20 years if you're owning your own multifamily building. Okay, those are generally more costly. They come with prepayment penalties, yield maintenance, but they can be a little bit more predictable in cash flow because your payment's locked in. And so when the market started adjusting, that's one less thing that's not adjusting on you, like what we just had in this last cycle. Even if somebody had a fixed interest rate on their multifamily property, they still were impacted by the doubling and tripling of insurance rates and the doubling and tripling of tax bills on their property. Okay, then you can also have floating rate debt. Okay, floating rate debt in today's commercial mortgage market in the United States is generally based on SOFR plus some sort of lender spread. Okay, so the lender is going to take a look at see where SOFR is, and then they're going to add in their 1.5 basis points or 150 basis points or 200 basis points on top of SOFR. Okay, but since both SOFR moves, that can, as we know from the past 2 or 3 years, can lead to several surprises. Okay. Now, again, remember, we're a lot of investors, and I would challenge even some newer operators are like, when the Fed lowers their interest rates, we're going to be able to refinance and lock in our extensions. We're going to be able to get or move to more fixed rate debt. But if we take a look at what happened in the fall of 2024, the Fed actually started lowering interest rates, but what happened to commercial mortgage rates? They went up. Okay, so why did they go up? All right, well, if the mortgage rates increased, they increased based on credit tightening and higher risk premiums. And here's the thing, a lot of investors didn't really understand that the Fed and the commercial mortgage rates weren't intimately tied together. The Fed fund rate impacts mortgage rates, but there's a lot of other things that fall in to impacting mortgage rates. Okay, and that can be supply and demand for credit. All right, it can be lender risk appetite. Does the bank actually really want to write more loans, and do they want to write more loans on that asset? Okay, so when the Fed started lowering mortgage rates in September, there was a whole slew of operators that were wanting to refinance and lock in the lower rates. The lenders essentially not wanting to increase the balance on their balance sheets a whole lot, they saw the opportunity to kind of pick and choose who they wanted to refi with. But that's not the only thing. Okay, we have to take into account the actual U.S. market, the inflation expectations, the different credit spreads, the bank's balance sheet, how healthy is it? But most importantly, the 10-year Treasury yield. Okay, that right there is one of the biggest impacts outside of the Fed's fund rate to the commercial mortgage rate. All right, so as a passive investor, Why should you care about all this? All right. Well, if you're going into an equity deal into the upper layers of the capital stack, if you're choosing to go into an investment where you're taking on higher risk, you have to understand the debt structure on that particular investment. Because depending on the debt structure, you might go into a fixed rate loan, and that might lower the cash flow position right from the get go. Or if you went into an adjustable rate loan, you might have some breathing room as far as cash flow. But if that rate starts adjusting upward, okay, either permanently or temporarily, you're going to have a pinch in cash flow and possibly delayed or suspended distributions. Also, the type of debt that is used on a property might only have an interest-only period. And that's fine and dandy, okay? But what happens if you can't get into a better debt position, by the time that interest-only period expires, okay? So you have to understand what risks come there. And then, as we know, 2021, 2022 through 2024, if it's just purely floating rate debt, those things can actually blow up deals, pretty quickly if extensions and rate caps are not in place. So as a passive investor, when we talk about commercial mortgage rates, you want to definitely be paying attention to a couple key pieces of information. I would argue a lot more to understand the actual debt structure. But right off the bat, you want to pay attention to the DSCR, or the debt service coverage ratio. So essentially, you're going to take the net operating income divided by the debt payment and see what kind of ratio you get. Okay, at a 1.25 ratio and higher, that means you have at least 25% more cash coming in covering the expenses. So you got a little bit of wiggle room there. Okay, things closer down to 1, that means you're purely break even. Below 1, that means that asset is actually having to put cash in every month in order to survive. All right, and then you want to pay attention to the length of the loan. If it's an interest only type of, only has interest only payments on it. If so, for how long? What is the plan to move that from interest only to either equity pay down or into a more fixed debt type situation? Or can you extend the interest only period? Now, here's the thing. I think another thing that passive investors don't quite always understand is that a multifamily deal, doesn't just qualify for its debt one time. So maybe you have bought a primary residence, okay? At that point in time that you closed on that particular loan, maybe you put a 30-year fixed rate mortgage with your local bank on that loan, you only had to qualify it for one point in time. So if you all of a sudden lost your source of income, either say you got laid off or a spouse got laid off, as long as you had reserves and could pay the bills, the bank wasn't going to come for the asset. However, when we have these larger multifamily properties or self-storage units or whatever it may be, larger commercial real estate, we have what we call covenants. And that means the bank is looking every so often at the debt service coverage ratio of the property, how much excess cash is there, and if it can't meet the operator can't meet the loan covenants, then they have to renegotiate the terms of the loan. All right, so again, I think that's another misconception that I think passive investors should be aware of. And this even goes for fixed rate debt loans. Okay, so it's not just for adjustable rate mortgages, but even for fixed rate debt. Deals, large deals, commercial deals have to meet these covenants. All right, so anybody that's new to passive real estate and wasn't in, a multifamily deal, with floating rate debt from 2021 to 2024, you might be going, Whitney, well, why are we even talking about this? Well, again, that debt structure can, seriously impact the deal. So let's say we had two different operators. One operator locked in and maybe this is two deals with the same operator. Okay, the one deal actually had fixed rate debt on it. Okay, no cash flow, or excuse me, cash flow, stable distributions ongoing. And when they hit a choppy market, interest rates start adjusting. As long as they can meet their loan covenants, there's no pressure to sell. Okay, they're able to hold and wait for a proper profitable refinance or exit. However, for deals, and we have deals in our portfolio, both fixed rate debt deals and a couple, a handful that have floating rate debt. You know, that floating rate debt, during that time period, interest rates soared. Okay, it really limited the cash flow. And if you don't have deep banking relationships, that operator might find themselves in a serious pickle with either limited refinance options or facing not just capital calls. Okay, capital calls in and of themselves on performing assets aren't the worst scenario, but the worst scenario would be a distressed sale. So as you can see, same market, same asset type, same business plan. The only difference there is the debt structure. And that is one of the biggest lessons in learning out of the past 3 years. Okay, so let's move on. I always want to empower you as a passive investor. Okay, I don't want you to attend these webinars and go, oh my gosh, such doom and gloom. I'm never going to get into passive real estate, because that's not the point. We need to get super savvy and figure out, okay, if I'm not just sitting here looking for the Fed to cut the interest rates, what am I looking for to happen in the market to kind of give me a good signal that this might be a better time to get into an equity deal. So let's take a look at that. All right, so I'm going to go through 3 different areas that a limited partner should pay attention to. Okay, the first one is macro indicators. Okay, so these aren't things that we as a passive investor can impact at all. They're 110% out of our control. All right. Now we get an influence, we get to vote potentially for the person that will impact these things. But not all the time do we actually have a direct impact. So 10-year Treasury yield, okay, that's the anchor for long-term borrowing costs, especially with commercial loans. But as we've already gone through, that's not the only indicator. We have to look at the overarching market, okay? Is there inflation occurring or on the horizon? Right now, we have tariffs, being built into the US economy. Okay, so we will see some sort of inflation. Okay, how long will it go? How deep will it go? I do not know, but that's coming. We have the economic growth forecast. Okay, if we have stronger growth, we're going to have better yields on the 10-year Treasury. What's the Federal Reserve's monetary policy? Okay, so if the Federal Reserve kind of sets the thermostat, the 10-year Treasury is really going to tell you like what the weather is. Okay, so the Federal Reserve, they're going to be able to impact the monetary policy a little bit, but that plays into the overall 10-year Treasury. What's the global investor demand for US Treasuries? Okay, the more demand there is, the lower the yields on the 10-year Treasury. That's good for commercial real estate. The less demand for treasuries, kind of the pattern we're seeing a little bit right now, the higher the yields, because those 10-year treasuries are riskier, and our quote unquote bond vigilantes will want to get a better yield, okay, because they're taking on more risks by buying a 10-year treasury. All right. So we want to see if there's more demand, lower yields, good for commercial real estate. If there's less demand, there's going to be higher yields in the 10-year Treasury. Not great for commercial real estate. And then you've got the overall geopolitical environment. Okay, just how much uncertainty is being baked into the economy right now. All right, and then we already talked about, we got our SOFR rate, and then bank lending activity. Okay, the 10-year Treasury can be low. We can have an amazing SOFR rate, but if the banks aren't in a healthy position to actually take on borrowers, okay, then they're going to keep rates high and kind of cherry pick from the borrowers that they have available to them. All right, so that's one. What's the macroeconomic climate? Again, we cannot impact that. All we can do is just kind of watch. Okay, then let's say you're just like, Whitney, I want to actually, I'm less concerned about the macroeconomics. I need to build my portfolio. How can I do this safely in the current volatile macroeconomic environment that we're in. Great. Here you go. You need to thoroughly underwrite the operator's debt strategy. Okay, so here's some questions. Take a screenshot. Before you write a check into any deal, you want to know, is that the debt being used on the deal fixed rate or floating rate? Because that's going to kind of send you down a decision tree. All right. Fixed rate, you're going to want to understand all the terms of that. Is there yield maintenance? Okay. I mean, because if there's a high yield maintenance or prepayment penalty on that debt, and you actually have to sell in 3 years, it's going to cost you to sell. Whereas floating rate debt generally doesn't cost you to sell the property, but you're going to have to pay for interest rate caps to essentially an insurance policy to keep the interest rate lower, keep it protected from runaway SOFR, and extension so you can extend the loan. All right. What's the overall loan to value ratio on the property? Right now, I am targeting equity deals that are 65% and under. Okay. So the market could drop, 20%, and there's still equity in the deal. The investors have not been completely wiped out. Has the operator stress tested the deal at a higher interest rate? Right? So not just a higher cap rate, but at a higher interest rate, especially if that operator is using floating rate debt. Okay, very important here. Is there adequate reserve capital to cover potential shortfalls? Okay, these are huge lessons and learnings that we as a company, passiveinvesting.com, are taking into account for our future deals. You should take our lessons and learning and put them in your underwriting for any other operator. Also, does the operator have strong lending relationships to create backup financing plans, or is their lender relationship, do they only have one or two and they're going to be in a short sell situation? All right. So number one, let's pay attention to the macroeconomic environment to see if we can actually find a better time to go into equity deals. But, if we're willing to take on that risk, how do we mitigate it? By underwriting the operator's debt strategy. All right. Then number three, this is kind of, one piece of advice that I've really been trying to drive home with people where we are in this current market cycle. Becoming the bank, being the bank is amazing for several reasons. Because when traditional lending pulls back, okay, there's a tight lending market and the demand for private capital goes up. Therefore, private lenders can step in and command better yields, right? Kind of like if the 10-year Treasury does, like those bond vigilantes, right? If they start seeing risk in the environment and a lot of people stop buying bonds or they sell off their bonds, those people that are seeing it are going to be able to command higher yields. Kind of the same thing. We're taking advantage of the environment. Okay. It's an opportunity right now. And so we actually have a couple opportunities with our passive investing club. We've got our PIC debt fund that lends at 6 to 10% secured by first lien position, and then our PIC yield fund that lends at 10 to 14% on multifamily assets that are in a promissory note or a second lien position. But most importantly, if you're going to become the bank, the whole premise here is to invest in vehicles that are going to allow you to stay liquid and stay patient. Okay, that you're not getting into these 36-month-long lockups. Because why? Because we will see bond yields come down at some point in time. We will see the market start going into recovery, and you possibly want to get back in at that point in time. All right, guys, we are going to move to the Ask Me Anything part of our show. But before we do that, I just want to make sure that if you want to, or if you haven't already, make sure that you join our Passive Investing Club. There you can go to passiveinvestingwithwhitney.com or scan the QR code on your screen. You'll get a free one-on-one call with me to discuss your investing goals, access to all of our educational materials, and priority access to our open deals. Guys, I already see a couple questions coming in the chat. This is an amazing opportunity to drop those in. Okay, Frenchie, So please explain CMBS and their rates. That is kind of beyond the scope of this particular webinar. Um, what we are trying to help investors understand here more specifically is why if Jerome Powell right now is not going to cut interest rates, right? We've already talked about on previous master classes why he's not looking to do that. Okay. The Fed is, every time they meet, they're just like, ooh, inflation, it's at 2.4%, I think, for April. We're still seeing stability in the, we don't have negative, we actually have had 1 quarter of negative GDP, not 2. So they're still trying to create this quote unquote soft landing. So, but just because, let's say Jerome Powell does start cutting interest rates, we've already proven that if there's more macroeconomic volatility that's happening, interest rates, commercial interest rates may not come down at all, if nothing else, because it's based on the 10-year Treasury. So I really wanted to kind of drive that, together. Not so much getting into commercial mortgage-backed securities, which is a whole other ball of wax. But Frenchie, you gave me an idea. Maybe we should do, tap into that for another conversation. What are the signs the bank is looking for in order to increase lending? So the bank, every bank is going to be a little bit different. If we go back to these earlier slides, the banks, going to be looking for, what is the supply and demand in this particular area? What is the lender risk? Okay, is this an asset they even want to lend on? If they don't want to lend on it, they might charge an outrageous rate. I mean, they might be willing to take on the risk if that person is willing to, pay that outrageous rate for the risk. Okay, what are the, inflation expectations? Well, I'm going to jump to the 10-year Treasury. What is the 10-year Treasury yield? If the bank can actually buy Treasuries and make a higher yield, they don't have to take on more risk with writing loans on assets that they may or may not want to be into, especially if their balance sheet is not healthy. Okay, but when the yields drop, okay, now that's actually good for commercial investors. The banks are going to look to get more yield, because what is the bank doing? They're taking depositors' money and they want to make the most yield, the most spread as they possibly can on that. So and then we get into inflation expectations, credit risk. I'm not a banker. I don't think those exactly play into this, but only so much as they impact the 10-year Treasury. Also, I think, supply demand, I don't think this can be, underweighted enough or overweighted enough or overstated enough, is that you got to have good quality assets to lend on. Otherwise, the bank, if they see an asset that they really want to be in, they're going to make it work. What other questions do you guys have? Is multifamily still strong and resilient and recession based on Q1 data? I actually just saw a Q1 report from CRE this morning. And the multifamily lending for Q1, that report just came out in the past 24 hours after I put together all this. And actually, we're starting to see stronger indicators. It is not recovered, but it is definitely trending in the right direction. So that's for lending on multifamily. Okay. Now, multifamily as an asset class, is it still strong and resilient and recession based? It can be in certain markets. And again, I think, for markets that are completely overbuilt, I think that hyper supply still needs to be absorbed. And so you're gonna, in some key markets, I've heard like Austin, Phoenix, that hyper supply is being absorbed right now. Probably at the beginning of 2026, we're going to start seeing rents recover. Other markets are just now moving through their hypersupply and probably won't see, positive rent growth until like later in 2026 into early 2027. And so in the grand scheme of things, that's a relatively short time. Um, as a passive investor, especially if you're counting on that cash flow, that can be a really long time, right? So I think this lends to a couple of different things. One, making sure that you're diversified over the different parts of the asset capital stack, for one. Two, if you say you have a chunk of capital that you're looking to deploy, don't deploy it all in the same part of the market cycle. Okay, meaning you diversify over the different parts of the capital stack, and then maybe overweight your bottom tier, like your debt tier, and then plan to invest increments over the next few years. Create a deployment timetable, and that way you're deployed over different parts of the market cycle. Okay, that way you're not all in multifamily boom or multifamily bust, right? You've got part of your assets that are, as it moves through the various parts of the cycles, you've got one cycling out, hopefully all at the top of the market, but not all cycling out at once. Or if, multifamily gets compressed again, they're not getting all compressed at once. See here. Become the bank. Somebody asked me to elaborate on become the bank. That is actually write the loan. So for here, let me back it up, become the bank. Let's say the PIC debt fund, let's take that as an example. That is actually, that fund writes loans to fix and flippers in first position, so they can actually go find a property, rehab a property, and either flip it and sell it or flip it into their portfolio with permanent debt. Okay, so they're the bank, they're on the debt side of things. All those investors, they're on the debt side of things. So they're getting 6 to 10%, in a very secured position. They don't get tax benefits, they don't get profit splits, waterfalls, all that sort of thing at the very top of the capital stack. They're in a very low risk, quote unquote, low reward position. But I argue that is because I can demonstrate to anybody you can actually invest, say, $100,000 and in 10 years double it. So you can get near equity-like returns for a very secured position. All right, so you're being the bank. So that fix and flipper, they generally cannot, they're not going to be able to go to their local credit union to get a good a loan that they would want to have a short-term loan for 6 to 9 months. However, they can come to our rehab wallet lending arm and get a loan for 6 to 9 months to execute their business plan. So again, instead of that person going to the bank, be it Wells Fargo or First National or whoever, they come to us and we're the bank. We lend them the money. We get our return. We get our points paid. They get their property in order to boost their equity position. Is SDRA more costly than the traditional IRA if combined with return results? Not necessarily. That is a whole, it depends. Okay, so so if you are, say, like so SDIRA, for people who are listening in, is a self-directed retirement account. Okay, you can have a self-directed retirement account that is pre-taxed, so we quote unquote call that traditional, or it's post-tax, like a Roth. Okay, so you can have the two different ones. All right, so that's very important. Now there's all different flavors of self-direction. Okay, if you go to Vanguard, they say, hey, you can self-direct your account here. Yeah, you can, as long as you're going to choose from their menus of stocks, bonds, and mutual funds. That's it. You can't actually buy your own single family rental or invest in private equity or invest in private notes there because they don't offer them on their platform. So then you can, maybe you've got $1 million in your Vanguard self-directed IRA. You could peel off $400,000 and bring that over into a true self-directed IRA with a custodian. And that custodian will allow you to invest in a menu of other assets that Vanguard wouldn't. Okay. So now here's the thing. Everybody makes money. What you're paying at Vanguard, and I even pick on them, even though they're one of the most transparent custodians with their fees, you're still paying an expense ratio to invest. Depending on the size of your account, you're going to be maybe, if you use their advisory service, you're going to be paying an advisory fee, and then you're going to be paying 12B-1 fees, all the marketing fees. Those tend to get buried in the prospectus. Okay. The average person, and I actually ran a scenario for some of my investors that I privately coach, that they lose about 31 to 33% of their portfolio if they're not careful with those type of fees at a Vanguard, Fidelity, Schwab. Here's the thing, that's conservative, okay? Because a lot of other advisors, financial advisors, they charge even more fees on top of that, and the situation just gets worse. I remember when my mom, I was helping her with her finances. I think she was paying a total fiduciary fee, all in, all of her fees, at 2.5%. So she was, over 30 years, she was losing about 40% of her portfolio to fees. Okay. Now, so somebody says, forget that. I'm going to get out of the Wall Street casino. I'm going to just go over here to, say, like Advanta IRA. We've had them on the show, a couple other people, and I'm going to self-direct there. But then they open their account and they're like, holy smokes, it costs like $300 a year. And every time I write a check, I get a wire fee or whatever. That's a lot of fees. The thing is, it's transparent, but you could potentially go into assets that you have greater control over than if you did stocks, bonds, and mutual funds. The only thing there that you have there in stocks, bonds, and mutual funds is the perceived liquidity. A lot of people consider that control, perceived liquidity. But here you could actually go, say you had money at Advanta IRA, you could actually go buy a rental property and manage it all yourself. Well, actually, you can't manage it yourself. It's in your self-directed IRA account, but you could go pick the property and, get lending for it and all that and make a greater return potentially than you could at, with one of the more traditional custodians. Long story short, the question was, is SDRA more costly than traditional IRA if combined with the return results? There's so many variables that play into that. I don't even know where to start. I will say I have made more money in my self-directed Roth than I have, looking at just my retirement account investments than I have in any other place. And it's because I've been very strategic about the assets I put in there. And one of the things I love putting in there are debt-like investments because they can grow tax-free and come out tax-free, provide me tax-free income for when I want to retire. They're very stable. So my strategy, not an investment recommendation. So we're going to cut this from our actual recording, is that I'm actually building out notes, debt fund investments, okay, and very conservative real estate. When I fully want to walk away from everything and no longer coach investors at all, not do anything, just right off into the sunset, I'm going to take my compounded note growth, flip it over to cash flow, and I'm just going to take tax-free income. Hand over fist. Then I have all my other assets. Okay, good. I'm glad that hit home. Now you might have been, some people might have been like, that was really wordy. It's because we had a really vague question. So I had to fill in a lot of the gaps there for people. Question came in. If I understand that if you invest in a debt fund, you're like a bank and lend money, but you don't get depreciation, which is true, which you get when you invest directly passive in multifamily deal. Exactly. Why is that? Okay, so a bank, you're actually an expense line item to the deal. You have to get paid, okay? But you're taking that position to have a secured position or an asset potentially that you can take back. Okay. So you don't get to take depreciation and then, in the worst case scenario, foreclose on the deal and take it back. That is just like so messy from an IRS standpoint. Okay. But on the equity side of things, you are partners. And so you're making money together and, heaven forbid, maybe losing money together. That for taking on that risk, okay, you're actually managing the deal, you're repositioning the deal. The bank has nothing. They're not putting any capital to improve an asset. Okay. They're not. They're just, you borrow money, you pay me interest rate for it. That's it. Okay. They're not trying to push NOI rents. They're not trying to do all these fancy things to boost the equity on the deal. Okay. Because of that, they do not get the depreciative benefits. Okay. So where does that land somebody who's looking at investing in passive real estate because they want the depreciation? Okay. I'm super conservative, but I consider depreciation as icing on the cake. I never go into a deal because of the depreciation benefits. I go into the deal because it preserves capital, creates cash flow for me, gives me equity growth. Okay, I'm looking for those big three first. The fourth one, I'm looking for some sort of diversification across the capital stack. Okay, making sure that I've got, as I've been illustrating in the past couple months, my tier 1, tier 2, tier 3 investments. Okay, making sure I'm well balanced in those different tiers. Then I pay attention to the tax benefits. Now, here's the thing. Somebody here might be listening and they're like, well, Whitney, I just liquidated, $1 million of my company's stock, and I'm going to be facing a huge tax bill. So I need to wipe out that tax bill. The question is, do you? Is that the best investment choice for you? Or because you liquidated, is it now good for you to make sure that you have your liquidity tier filled out? You start building your investments for cash flow. And then anything above that, we start putting into the growth tier. Okay. And getting tax benefits for. So we want to lessen the impact. Okay. But we shouldn't expect one investment to give us all pillars of wealth through all parts of the market cycle. Okay. You can invest in one asset that can give you 7 pillars of wealth, but you're probably only ever going to get 4, maybe 5 of those pillars at any one point in time, because as the market cycles, one pillar might appear, one pillar might disappear. Okay. So hopefully that answers your question. If you need me to give any sort of clarification, happy to do so. All right. Well, guys, we're close to wrapping up, but if you have additional questions, this is a great time to jump in the chat or the Q&A box and drop those questions in. Otherwise, thank you so much for spending not only your time with me here today, but also in investing in yourself. All right, another question came in. Do you already see the impact of ICE or tariff on multi-ops? Not sure what you, oh, I'm going to take a stab at that. For our investments, they tend to be we have A-class assets in pretty affluent areas. So we're not really being impacted by either one of those. Not by ICE. And tariffs, we're not doing extensive value add strategies like ground up construction. A lot of times our core assets, they've been purchased from a developer. So a lot of those things are already being taken care of. However, if you are investing in an asset in a particular area that has a strong population that might be targeted by ICE, I could see that being an issue for sure. That is definitely, I think, a travesty. Okay, I'm just gonna, put that down for a second. I think what will impact multifamily operations even more are if our building supplies go up, kind of like they did during COVID, right? Because of supply chain issues. I think if these tariffs are continuing to be carried out, we're going to see some temporary, if not more permanent supply chain issues on lumber, steel, copper, all those sorts of things until we can figure out how to source those here in the United States. My husband works in the lumber industry, hence a lot of the trees. But long story short, I know that they are ramping up lumber production in the United States. But that's going to take a year or two to at least to materialize and kind of suss its way out through, the system. And, I think they're estimating, somewhere between 3.5 to 4 years before we really see that production ramp up and the supply chain stabilize. So those things I can see impacting multifamily ops. Okay, but now we've got rehabs, right? Smaller rehabs. I think we're going to see longer supply chains, obviously, that are impacted by these commodity goods. What I think will be really impacted is going to be ground up construction. Okay, because that is very commodity driven supply. I mean, if you think about it, a multifamily building, all it is commodities. It's concrete, wood, all your different metals put together in a gazillion different ways to make a building. So I do see that impacting ground up construction as well as the lending rates for sure. So we've got a road ahead of us. I think here's how I look at it. Multifamily, even commercial real estate in general, is a good long-term bet. But if you're looking to make short-term gains, say like in the next 6 to 36 months, that could be like playing with fire, because I can't predict what's going to happen in the next 6, 12, 18 months. But I think over the course of the next, 5, 10, 15, 20 years, I still think, real estate is an amazing bet. Oh, oh yeah. Somebody said, thanks for filling in so many gaps when answering questions. Happy to do so. All right, guys. Well, again, thank you for joining in today. If there's not any last minute questions, we shall see you next week. Next week, we're going to talk about how artificial intelligence plays into you as a passive investor. Is it something to pay attention to, or is it hype? Where are we? All right, guys, take care, and we will see you next week.